Welcome to TMS Insights. It's the reporting season, August 2016. Ben Clark and Jeremy Hook to report on what's been the first major week of company reports, and quite a busy one, Ben. We've heard from some big companies and some important companies for us in our portfolio. So let's go through them. There's been some divergence in performance. Maybe one of the biggest ones, Ben, was Commonwealth Bank, which is the only major bank to give a full or half-year report in this season. Again, probably pretty much confirming what we have been talking about. Bottom line is nil earnings growth, maintaining the dividend and a solid position, but it's relatively unexciting.
Yeah, look, I think having watched Ian Narev present at the analyst conference, the thing he continued to come back to was that making money for a bank in lower and extremely low interest rate environments becomes increasingly challenging because on the cash side of things, people are pulling money out of cash because they're getting no return and trying to find other things to do with it. And then the banks having to access wholesale funding markets to fund their mortgage book, which is putting pressure on their margins. And they can't pass that cost on because of the political environment that they're in. So definitely, there's some challenges there. And I think that was probably the biggest negative you take out of the result. There were some positives, I thought. He's adamant that the bank won't have to raise additional capital, which has been, a view and the market has taken for some time now, but that might still change. We've seen bank CEOs say that in the past and then go to the market and raise capital. And keeping that dividend, even though it was flat, maintaining the dividend, with a lot of analysts suspecting they might drop their dividend, I would see as a positive as well. But yeah, I agree, Jeremy. I just think the banks in this environment are in for a period of very low earnings growth. And if they can maintain their dividends, I think that would be a good result because...
Yeah, and I think that the thing you extrapolate from the CommBank result is because it has been seen as the premium bank in the Big Four and has attracted a premium rating based on earnings multiples and asset multiples, that leadership of the group is probably being pared back somewhat.
Definitely. I think one analyst from JP Morgan sort of made the point that 5 or 6 years ago, CBA was generating a return on equity 600 basis points higher than the other three banks. And that's now been whittled down to 200 basis points or 2%. And just to put that into context, back in the mid-2000s, CBA was generating an ROE of around 25 or 26%. Yeah. It's now 16.5. So,
which is still very high, but not nearly what it was.
And so you can see the pressures that the bank is under at the moment, and you can't really see what's going to reverse that in the short term. So I think our view would still be that the bank's range trade for the next few years, if you use CBA as an example, at around $70, it probably looks pretty good buying, and around $80, it probably looks like a shorter term sort of lighten.
Yeah, no, good one. So moving along to other results, another big one out this week was Telstra. And again, at the top line, a little misleading. At the bottom line, though, earnings per share were down, dividend maintained. But Ben, discussion about CapEx spending to build the network, which was positive for the longer term, and a buyback too, off market and on market. So quite a bit in that result.
Yeah, some positives and negatives again. Obviously there's a small buyback that clients who are in Telstra will be able to take advantage of and sell some 880 odd shares if you're currently a shareholder back into the buyback at a premium to the current price using those franking credits. Yes. Some clients might be able to buy some Telstra shares now to participate in that buyback, a very small holding. The long-term future, I still think there's clouds on the horizon for Telstra, in that the mobile division, which is the remaining sort of crown jewel of the Telstra company, is coming under increasing pressure from competition. And, Telstra earns the largest margins in mobile of any country in the world, and we've seen that that's probably not sustainable. And what's happened with the ADSL business, which used to be a great business for Telstra, is competitors came in offering much sharper price plans for similar amounts of data, etc., and customers moved. And Telstra will either have to make the decision to reduce pricing to maintain customers, or to lose customers and keep their margins. But neither is ultimately a great
neither
scenario.
are good outcomes.
No.
Yeah, and yet one of the things that Andy Penn mentioned in the report there was just how much growth there'd been in data traffic, 60% per annum over the last 5 years, which is
amazing.
why they're doing this $3 billion of CapEx expenditure, because they see that trend very much continuing. But that's one part of the business they actually have to invest in to keep maintaining the returns that they're currently getting.
Absolutely. I mean, they've had 5 network outages this year now, and if you get many more, it's going to start to be a voter fail where you see customers move. So look, I think for the right client who's still very income focused, and Telstra, there still offers a place to be, because the dividend is sustainable for the medium term. But for those looking for growth, I think there's probably better places to be. We'd agree.
In terms of growth, one stock that we've been very much interested in invested in that did deliver good growth was REA Group, which had earnings per share growth of 16%. So certainly, getting very good growth there. Ben, the market reaction was a bit mixed, but it is a premium stock that often gets a little bit of a knee-jerk sell here and there.
Yeah, look, the share price came off. I would say this was a result that was great, but it wasn't probably right up there with some of the other results REA has delivered. We've become accustomed to seeing 25% earnings growth consistently, but there were reasons for that in the May and June months of the financial year. We had an election which put people off selling, and we also saw the traditional school holiday period, and listings in those 2 months really fell markedly.
Yep.
But what we'll probably see is some catch up in the start of the new financial year.
We didn't know in July. They did mention that it had been lower in July, but these things do, like you say, catch up over a period of time. So we're not negative on that in any way.
No, I think it's probably a hold at the current price. It's $61 again now, almost back to an all-time high, and it's probably one of Australia's premier growth stocks.
Great company,
but probably priced fairly appropriately at the moment, I'd say. And it does give you opportunities to buy it on dips, doesn't it?
It does, yeah. Another stock, car sales, we've spoken about in these insights, delivered a good result, earnings per share up 8%, but its stock hit a record high this week. It's really moved along, hasn't it?
Yeah, look, it surprised me, to be honest, because it also trades on almost a similar PE to REA, but the growth level's much lower. And also going offshore much more aggressively, which could be great for the business long term, but I guess there's still question marks in the short to medium term about, execution and those sort of things. So, look, that's probably one I'm personally a bit more lukewarm on, but I still probably warrants a hold. But the one thing you'd say out of early stage reporting season is we've seen the high quality growth businesses have been sold off heavily on day one and have rapidly come back.
Yeah.
And
there are a few of them, weren't there? Yeah.
There's been a few of them. So, maybe that's a trend that will continue.
Sometimes does. And we do have overwhelmingly most of the companies still to report, and we'll bring further updates as that comes by. But before leaving today's video, Ben, I'll just maybe talk about the market, which has had a very good start to the financial year. The last financial year ended not a great one overall. It was a pretty modest year. But a big beginning. I mean, what's the feel you've got in the market at the moment about the absolute level and what we've got coming up?
Well, I think that the game changer post-Brexit has been the RBA's gone back into a rate cutting cycle. And that's to try and control inflation. Now, there's a lot of people who are of the view that interest rates at these levels, even if you drop them, it's going to do nothing for inflation. But, the RBA's sole mandate is to control inflation. So, the biggest driver of equity markets is the interest rate setting. And we're seeing a rate cut. We're probably going to see another rate cut before the end of this year. And we're moving towards this sort of 1% interest rates that, which is still bizarrely seen as high in the rest of the world. So, I think that's one driver of the equity market. And, the other thing I'd have to say is, look, I think we still believe that in the blue chip area of the market, there's not a lot of growth. But in the next tier down, there's some good stuff to invest in. And that's what's driving the market. There's been somewhat of a recovery in the banks and BHP, etc. But really, again, they've just been range trading for the last year or so now. But there have been some really, and there's a number of stocks that clients would own that have done really well in the last 12 months. And that's what's almost sort of pushing the market higher, and I think that could continue. Where do you think the market will go for the rest of the year?
I think that, we have to hear how this season's going. I think we're going to see some companies report well overall through this reporting season, just to find the levels. I think the next leg up's going to get harder, and I think that next leg of monetary stimulus may not have an economic impact. So they're going to have to pull out some other achievement. And the same time, when a retiring Glenn Stevens says to the federal government to keep the budget under some sort of order, it's actually government spending that they probably need to stimulate greater activity. So it is a conundrum in a macroeconomic sense. But the good story from an investor point of view is company by company, bottom up, when we look at it, we're getting some really interesting stories, and provided we can find them at the right valuation, the returns are quite possibly still going to be there.
Yeah, look, I think clients by and large over the last couple of years, in the last 2 financial years, the market's virtually had no growth. But clients would have seen in their portfolios there's actually been quite good growth. And it's really the clients who've probably experienced that have been a bit more open to investing outside of those household names, because that's where the growth has come from. And that's where I would still encourage clients to look toward, because we've spoken about the banks and Telstra. It's a major part of our market, just those 5 stocks. And we've seen there that those 5 stocks are not growing.
And there's no earnings growth, and therefore share prices are going to be contained.
Right.
So that's where we're going to leave it today. We'll bring another update later in the August reporting season, and we look forward to speaking to you then.